Hello, this is Gavin Martin here from Cornerstone Wealth. We're presenting the retirement planning webinar this evening, and I've got Phil Watson, our digital guy, is probably the easiest way to describe you, Phil, online. How are you going, Phil?
That's all right. I'm going very well, Gavin, and it's really nice to see that you got our little counter on our new website. If you are with Christian Super, we're just learning how to report back to members about what kind of impact they've got, and so that's an estimate of how many microfinance products that Christian Super's members have actually been able to create. And it's like, when I saw the numbers, I'm like, surely that can't be right, but that's actually correct. We got over 4 million people have been impacted directly from Christian Super members while still getting retirement returns.
Phil's the digital guy at Christian Super. Phil, if you'd like to intro us, that'd be fantastic.
Sure. So yeah, once again, welcome to our webinar. And yeah, we're Christian Super, and we do believe in that God helps us when we pray. So I'm going to pray for us. So Father God, we thank you for the people who are listening in right across this beautiful country of ours. And Lord, we thank you that we can talk to you so freely, and that we can also talk, using technology. So, Father God, I just ask for your help for all of us here to learn something about how to do retirement better. Lord, teach us how to do retirement purposefully. We know that you want us to be useful for every day that you have here on earth for us, and we just ask for your help to be inspired, for Gavin to be able to answer our questions, and for us to just enjoy this time of fellowship and learning. In Jesus' name, amen.
Amen. Thanks, Phil. Appreciate that.
No worries.
And thanks for joining us. Feel free to chip in if you stay around for a little bit longer. Just before we get into the main content, it is important to articulate that today's advice is advice of a general nature only, so please seek your own personal financial advice before making any decisions, so it's specific to you. If you do want to seek advice, we can assist you. This is the process that we normally take you through. So we generally have you complete a questionnaire. The discovery meeting is about, once you've completed that questionnaire, it enables us to hit the ground running in this discovery meeting. And in that, we talk about what you're trying to achieve, where you're currently at with your finances and life situation, and then what are the pros and cons of the range of options. Now, one question that came up regularly throughout the interactions when registering for the webinar was, I'm X amount of age, I'm going to retire in X amount of years, I've got this amount of funds, how quickly is my super going to run out, or how much have I got to live on? Now, as part of that consultation, we actually put your details into our detailed financial modelling software and project forward. It's got assumptions in there, but it's a very comprehensive model. So as part of that, for those of you that are asking those sorts of questions, that's often the best way that we can help you. And what we find there is that it does take out a little bit of the worry because it gives you some certainty about your circumstances. And I find most often it's actually, oh, that's not so bad. That's quite actually a good situation. And so it can actually help allay some fears and concerns that you do have. That's the initial consultation. It's $385. Generally goes for about an hour and a half, and we email you a summary with links to further information. That might be all you need, or you might go to the next phase where we write specific recommendations in writing in the form of a statement of advice. We can then help you implement it and provide ongoing advice. Just thought it was important to cover that off because so many of you ask questions about details of, I've got this much money, I'm going to retire at this date, what are things going to look like for me? That's the best way to help if you're wanting those answered. One of the key things I'd like to talk about in this first webinar about retirement planning is the emotional phases of retirement. Now, this has been generated, or this concept has been derived from a study that occurred in the United States a number of years ago. It was, I think, prior to and again, a follow-up questionnaire happened around the GFC, but it just explains the emotional phases of retirement, which is, I think, people find quite helpful. So I'll try and run through it, and then we'll go into how much you need to retire, how do you fund retirement, etc. So looking at this study, they found that the imagination stage, the stage where you haven't really thought about retirement, but you kind of imagine when retirement might be, and generally that phase goes between about 15 years prior to retirement up to about 5 years prior to retirement. So the key characteristics there are that you might still have, or you might be at that stage decreasing your expenditure and increasing your savings. So you might have kids that are no longer going to school, they might be coming off your hands, you might be empty nesters, the mortgage might be getting towards being paid down. But you haven't really worked out exactly what you need to retire on, and so it's kind of in the back of your mind, and there's often some anxiousness about not knowing or having a goal in place of how much you need to retire, and so that can be a bit of a concern. Going through the initial consultation that we talked about can often alleviate some of those concerns and set you on a path of knowing what you need to work towards. The hesitation stage was largely introduced in the second survey after the GFC, so a lot of people had their retirement thought through, but there was a bit of hesitation when they realised that, oh, hang on, I now haven't got enough resources to retire on. I'm a bit concerned about that, and so a lot of people actually didn't retire. They hesitated. And so that hesitation or that cautious period where you're not really sure that you're all sorted was introduced around 5 years out from retirement up to 2 years. Now the anticipation phase is generally in the 0 to 2 years out from retirement. At this stage you really have your goal sorted. You're just working towards completing those goals and actually retire and reaching retirement. There is often that is, particularly in Australia, that is focused around the pension age, so the age at which you can get some government support as well. Because if you are needing to live off your own resources without the age pension, you do tend to eat into your resources more quickly unless you have sufficient resources to live off the earnings of those. So that's the anticipation phase. 0 years is retirement, so that's the red line here. Now, one thing to note there is that often it's been a goal for a long time and you're looking forward to it, but the experience that I have with clients going through it is that it's not always a bed of roses and elation and all great, because it is a bit of a transition, and they've called this the realization phase, that you're actually transitioning from one phase to the next. Now often this can be the extent of the emotions that you feel and the challenges of not working, particularly for men that have worked full-time for a lot of their lives, and going to no paid work and haven't filled that gap. That can actually be a really tough transition. So the realization year is not always as great as you might anticipate, and there is a bit of a transition to go through. It is good to think through what you're going to do with your time, particularly if you have gone from full-time work to full-time no paid work. So it is important to consider that. The reorientation phase is that generally after a year you've gone through a whole season without work. As I was going to articulate, that in this realization phase or even the reorientation phase, scaling down from full-time to part-time can actually help help that transition, so it's not a working intensively going to no work at all. It can actually assist transitioning with some time, with some paid employment over time. Reorientation is really where you're settling into a routine 1 to 15 years out, and then the reconciliation phase is where you start to potentially lose some of your close friends, and there are those sorts of difficulties that you tend to experience. It's a very detailed questionnaire or survey that was completed, but if you can identify which phase you were in, you can identify some of the emotions that you can feel in that phase, and then you can work out what to do with it. Particularly in this anticipation and imagination phase, they do talk about getting assistance to work out how you can, what your goals need to be and how much money you need to live on, and that's what we're trying to address here through this webinar. Another survey that I've recently read was, what do people who have retired think they should have done more of prior to retirement? And one of them was in the Australian space, to actually learn more about their superannuation, because that is a significant part of their lifestyle in retirement. So you guys being online for this means that you're ticking that box to a large degree. Just one other thing before we get into and it relates to the emotional phases of retirement. This is Bernie Salt, who's with KPMG, he's a demographer, and he's talked through how our phases of life have changed over the last 100 years, and he's pulled the information from the population division of the United Nations and some data from KPMG themselves. But basically, they're saying that in 1928, you would have childhood up to onto your teens, then you'd go into a work life, and then you'd be considered old age into your early to mid 50s, and the life expectancy was just over 60. So you'd have a very short time frame, and I think the pension age was something like 60 years of age at that point in time. So there are very few people on the age pension. You would work right up into the age pension age, and then only a few people would actually survive beyond that. Another 40 years later, and the key difference is that there's an adolescence period where we're studying longer, potentially doing some university, but mainly just high school education, and then a longer work period up until your early 60s, and then old age would have been considered early 60s to where life expectancy was about 71. So there was a few more people who might have been on the age pension at that point in time. Now, another 40 years later, in 2018, still another 10 years earlier than where we are now, life expectancy is actually a bit later again now. I think it's mid-80s for women and slightly less for men. But the key thing here is that adolescence has been pushed out until 30 years of age, representing the fact that so many people don't get either don't leave home or don't get married until their 30s. So it's really an extended adolescence period where you might be studying longer, transitioning into the workforce. There's a work period that goes from 30 through till 55 or mid-50s, for example. And then there's this other phase, and he's colour-coded the same as adolescence, but where you might actually start to take some other career breaks, and then this other phase here, the blue phase, dark blue phase here, he talked about the portfolio lifestyle. So it's where you might not actually retire, but you might actually take some career breaks, utilise that long service leave that so many people just take at the end of their working life rather than taking it during their working life. So the key difference is this phase here, and I guess he's trying to highlight that it is good to and it is healthy, and there's lots of research to suggest that it is healthy to maintain paid employment and or volunteer employment as a portfolio lifestyle. So you're not missing out on the travel or spending time with family, but where you can and work allows, mix that up, take breaks and or work part-time and balance your lifestyle, and potentially work longer because we're actually living a lot longer. But what we find is that because pension age is currently 65 to 65 and a half, a lot of people finished up at this point in time, and then they've got a long period of retirement. But it all depends on your particular circumstances and health. But just highlighting the transition and the change over the last 100 years. So the key question that a lot of people asked and continue asking, and it is good, is how much will I need for retirement? There's a couple of different ways you can answer that. One is or three basic ways you can do it. Often you can just say, what's 65% of my after-tax pre-retirement income? So if I earn $100,000 and after tax that ends up being $70,000, and 65% of that, I should have chosen easier figures. Let's say our after-tax income was $100,000, therefore the 65% of that would be $65,000. It's a very rudimentary and basic way of working out your retirement needs, not very accurate. Another way to do it is to base it on other people's experience. So you could actually, if somebody who has a similar lifestyle to you, similar expenses, does similar things, ask them what they need to live on, and it's not a bad representation. The most accurate way is actually reviewing your expenses and make an estimate of how they may change over time. So you might go from two cars to one car if you're a couple and you don't need two cars when you're both retired, for example. You might have less work travel, you might have more other travel, leisure travel. So trying to factor all those expense changes in is probably the most accurate way of doing it. If that all is too hard for you, then the next best way is to look at a survey. So there's a survey that ASFA, the Association of Super Funds Australia, does on a quarterly basis, and the last survey was in March of 2017, so that's what these figures are. And a modest lifestyle for a single person is around $24,000. A modest lifestyle for a couple is $34,000, nearly $35,000. So a comfortable retirement for a single is more like $43,500, and a couple getting close to $60,000. Now the difference between comfortable and modest retirement, you can just look up ASFA retirement needs, or ASFA retirement survey, or cost of retirement, and it'll come up in the Google search, and you can look at these figures, and it goes into the details of what that might include. But for a comfortable retirement, it might be going to the movies, eating out every now and then, upgrading your car every 5 to 10 years, and doing the occasional overseas trip. The modest retirement wouldn't include those additional items, so you can get a bit of an indication of those differences. Just one thing to note before we move on from how much you need to live on, ASFA has started doing a survey for once you're over 85, what you need to live on. So you can see the difference here for a couple, a comfortable retirement for a couple who's over 85 has dropped maybe $5,000 between when you're over 85, because I guess you're less active and you're not able to do the travel and those other expenditure. So you can see there's a little bit of a drop when you're over 85 and might not be having as many expenses. Fiona's asking, are those figures pre-tax? So yeah, this is a not pre-tax, so this is an after-tax money. So this is actual dollars that you'll need to live on. So if you're getting paid employment and it's taxable income, then you would need to factor in the tax on top of those figures. What we do find though is that because of the Senior Australian and Pensioners Tax Offset, which means that you can generate income up to $29,000 tax-free, and the fact that most money drawn from your superannuation over age 60 is tax-free, generally we don't need to factor in tax. So it is actually most of what income that you're generating at that stage is tax-free money, so it doesn't impact as much. Jenny is saying, are you talking about per year? Yes, so that's a per annum figure, Jenny. So for a comfortable retirement for a couple, $60,000 is an annual figure. Susan says, is the tax threshold different if you're retired? Yes, I just mentioned there's a Senior Australian and Pensioners Tax Offset and a low income tax offset. So for a single in age pension of age pension age, you can get access to, or you have a tax-free threshold of about $29,000. Thanks for those questions. Now, one key thing that also impacts how much you'll need to live on retirement is where you're living. And I just thought I'd quickly address a couple of those questions. So where you live in retirement will determine your costs. So a lot of people, just a few comments on that. So downsizing, sometimes it doesn't provide the financial outcomes that you're wanting to achieve, because if you're downsizing from a larger, older home to a smaller, newer home, and you're in the same suburb, often after stamp duty and selling costs and setup costs, you don't often net as much as you think from the downsize process. So just be careful about that. It can actually mean that you don't actually net as much as you would want. There was a new rule announced in the budget that hasn't been legislated, but I think the legislation has been drafted, where if you sell your home that you lived in for more than 10 years and you sell it from the 1st of July 2018, even if you're over 65 years of age, you could actually put in, as an individual, $300,000 into your super. So downsizing actually can be beneficial. Just factor in that new rule that comes in on the 1st of July 2018 if you're considering doing that. The sea change, a tree change, so moving from a city to a coastal or regional area, that often can net some difference in the transition. But do consider your community, your closest to family, and the amenities as well. So are there the hospitals and aged care facilities and support that you do need? So factor that in. Retirement villages are great for community, but they're really poor investments. So you may have heard in the media recently about some of the retirement village providers who have had less than ideal contracts with their residents. Whenever you look at those contracts, they're actually very, very poor from a financial outcome, but most people don't go into them because of their investment returns. They go into them because it's a great community and a great support. So just factor that in. And then granny flats as well. There are some rules where you can either transfer your home to, for example, your children and have a life tenancy to live in it, or you can pay your children to put a granny flat on the back of their property or your property, or you could just live in the home of your children, for example, and have a life tenancy as well. So there's there's a strategy there with Centrelink that can be advantageous sometimes as well, but there is a bit of complexity from a tax and Centrelink perspective, so you do need to factor that in as well. But where you live does impact how much you need to live on. If we go back to that previous slide, if I can, how much it costs to live in retirement. These figures, these are annual figures that assume that you own your own home and there's no debt on your home. So if you are renting, then you need to factor in probably a little bit higher costs, but you can also factor in Centrelink paying you some rent assistance as well. How to structure your assets. So one thing that I commonly come back with is people asking me, should I buy an investment property? Should I, as I'm approaching retirement, should I buy shares? And one of the things that I often come back to is a really simple and common approach to structure your assets for retirement is to own your own home outright. Now, this may not be for all of you. Some of you won't own your own homes, and there's other strategies that you can apply here. But for those that own their own home or can purchase their own home, it is a great structure. It provides you that certainty, and it limits your increasing costs over time that you get that you would get if you're renting. So owning your own home, having a cash reserve of 6 to 12 months living expenditure. So if you're saying that you're going to live on a $60,000 comfortable retirement if you're a couple, then having $30,000 to $60,000 in an emergency fund that's accessible to you. You can have it in most of it, a minimal amount in your transaction account, and the rest of your cash reserve in an at-call account earning reasonable interest. Now, a range of providers that allow you to have sort of at-call money earning reasonable returns of between 2 and 3% at the moment. So having that cash reserve there provides a buffer should you need access to funds at a short amount, at short need. The other with the remainder of your resources, often the way that we suggest structuring things, and it works very well, is to hold the remainder of your assets in the pension phase of superannuation. And the reasons for that are that it's tax-free earnings on the money, it's tax-free drawings from the money, and if you're able to structure it so that the components of it are tax-free as well, and we'll talk about that in subsequent webinars, then it will transition or pass to your beneficiaries tax-free as well. So there's a simple structure, and with this money being in the pension phase of superannuation, or all other assets being in the pension phase of superannuation, it then also means that you can just be paid as an income from it, either on a fortnightly, monthly, quarterly, or an annual basis. It keeps things really simple, and it maximises your situation for most scenarios. So just consider that when you're planning. Now, how to provide for your retirement. So there are generally three sources of income in retirement. The first one is your superannuation money. Generally, that involves moving your accumulation account that you're putting money into as you're working or putting extra contributions into. It involves moving from that accumulation phase to pension phase, where you start to draw on your superannuation. So one source of income in retirement is your super. Generally, it's by moving it to pension phase. The second source is the government age pension. There's an income and assets test, but if you within those income and asset test thresholds, you'll get a government pension that will supplement your other income. Now, as well as that, you may have some other savings. So you might own an investment property, you might have some money in the bank, you might own some shares, you might have some other assets or run a business, for example. That's the third source of income in retirement. Now, if you were going to live off your own investments only, so you didn't have, well, could be some of it could be in superannuation, but if your total assets were, if you were just living off your own resources, then there used to be a simple rule that we'd say, well, you need 12 times what your income requirement is. So we talked about a comfortable retirement being $60,000 per annum. If you were going to be totally self-sufficient, we used to say, well, a general rule of thumb is that you need 12 times that to provide for that income on an ongoing basis. And basically what we're saying is, if you need $60,000 income, generally need 12 times that, or $720,000 in capital, and assuming that it returns 8.3%, that will provide your $60,000 return, and you'll maintain your capital amount. Now, with lower interest rates and lower inflation, returns are also reduced. So it might be better to actually say, to provide a $60,000 income, you need to factor in 15 times that income requirement in capital that you would need. Now, I can hear a number of you saying, well, man, that's just not going to happen. Don't get worried, because this is if you're only living off your own resources. Now, when you factor in the government age pension, you can have a lot less and still provide for your income needs. But if you were to live off your own funds, then that's the kind of money that you would need. So for those of you thinking of retiring before your pension age, you need to live off your own resources, and you might need to factor in these sorts of figures if you're going to finish up paid employment and support yourself without any age pension. So 3 sources of income in retirement, but don't forget there are employment and business sources of income as well. So they're either part-time or full-time, or however you derive that income, they are good sources on top of these 3, but these are generally the 3 that we factor in most of the time. Let's assume that you might be eligible for the age pension. You firstly have to satisfy an age criteria. So, and a lot of people align their retirement, particularly in Australia, with the age pension. And so your eligibility age is based on your date of birth, and it used to be based on your gender as well. But that was historically based on your date of birth. But most people these days, if you're looking at retiring now, the pension age of both men and women is now equal, and you'd have to be 65, and now it's actually turning to 65 and a half. So someone turning 65, or someone born after the 1st of June 1952, now needs to be 65 and a half. So we've just hit that threshold now. So you've got to wait an extra 6 months before you're eligible for the age pension. So check out what your date of birth is, and then look at what your age pension eligibility age is. Now there is a proposal in place to increase that out to 70 years of age with a similar sorts of time frame. So you would say from the 1st of January 1957 through to 18 months after that, it would go from 67 to 60. It would be 67 years of age. 18 months after that would be 67 and a half would be your age pension age. So check out when your date of birth is and then when you're eligible for the age pension. So the first criteria is your age. The second criteria is an income test. So if you're a single person and your income is under $168 per fortnight or $4,368 per annum, then you'll get the full age pension. If your income is higher than that, then it reduces the age pension of which that you'll be eligible for reduces by 50 cents for each dollar over $106 per fortnight, to the point that it cuts out if your annual income is over $50,559. So you get a part pension up to that threshold. For a couple, now a couple's income is assessed jointly and effectively split in half. So if there's one spouse working and the other spouse is not working who is eligible for the age pension, both spouses' incomes are factored into the equation here. So for a couple, similar sorts of figures. You can earn up to $300 per fortnight or $7,800 per annum without the income test impacting your age pension. And again, your pension is reduced by 50 cents in the dollar for income over $300 per fortnight combined. So a couple can earn up to $77,438 or slightly under that and still get a part pension. So that's the income test. There's also an assets test. So Centrelink will pay you the lower amount. So if the income test provides a particular age pension amount and the asset test provides a lower pension, you'll be tested under the asset test. So whichever test, the income and assets test that provides the lower age pension, that's what you'll be paid. The asset test works like this, that if you're a single person and a homeowner and you have assets less than $253,750, then you would be eligible for the full age pension under the assets test. Now, if you've got assets over $550,000, you'll get no age pension. For a single non-homeowner, the rates change from $456, and the pension cuts out at $753,000. Couple homeowner, the asset test threshold is $380,500, and you'll get no pension if your assets go over $827,000. So this used to be over $1.2 million, but pulled back to $816 initially on the 1st of January 2017. Now these thresholds are valid as of the 1st of July, but they are updated quarterly. So I think they'll be updated again in September. Got a couple of questions. Normally raises a few questions, so thanks for those. Kevin says, what if one couple doesn't meet the age qualification? So you get basically half the age pension, half the couple's rate of the age pension is, so one person is eligible in that case. Lynn says, does asset include money in super fund? So when we're talking about the asset test, assets are superannuation, pension money, cars, contents, shares. It includes most assets. There's very few assets that are excluded from that test. It does exclude your family home. So if you own your own home, then that is excluded from the asset test. One asset that is excluded is your superannuation money if you are not of age pension age. So if your superannuation is in the accumulation phase and you are not yet of age pension age, that is not a tested asset. And there is a strategy that we'll talk about in a webinar in a couple of months' time, where you can hold as much asset as possible in the lower or the younger spouse's name who is not yet of age pension age, so the asset isn't tested, and the older spouse who is of age pension age can then potentially get the full age pension until the younger spouse turns age pension age and their superannuation becomes accessible from a Centrelink perspective. So that is one strategy that you can consider applying. The assets are the assets including the home or excluding the home? So Fiona, they're excluding the home, as I just mentioned, the home. And Jenny had the same question. Does it include the home? No, it doesn't include the home. That's excluded from the asset test. So that's the age pension. You first have got to meet the age criteria, and then there's an income and assets test. Whichever test provides the lowest age pension, that's what you'll be tested under. Now there is for a homeowner single person, you'll get the full age pension if your financial assets are up to about $150,000, and for a couple homeowner, whilst the asset test is $380,000, it's about $250,000, $255,000 they can hold in financial assets and still get the full age pension. So it depends on what these assets are made up as to whether you'll get the full age pension, because the income test does factor in as well. I'll go into the Centrelink and Centrelink strategies in a couple of webinars, I think in a couple of months' time. So if you're interested in Centrelink and understanding more about that, then tune into those webinars. Now here's I had a few comments, and I often get comments about people hate these slides, and they hate these sort of concepts of how much money you need to live on in retirement, because they feel as though they're not going to meet their needs, and it just causes stress. Now, if that is you, then I encourage you to actually do some analysis on your own details. That could be through a consultation with us, or there are other tools. The government's Money Smart website is actually a good website that factors in the age pension, and it projects forward in a very simple way your retirement expectations and what your situation might particularly look at. But we're not meaning to cause concern by sharing these slides, but try to give you an indication of how much you might need when you're factoring in the age pension and your expenditure. So we walk through a few examples, and the first one we're starting with is Joe and Mary, who are 65 years of age. They're of age pension age. They've turned 65 before the 30th of June this year. They're retired, they own their own home without a mortgage. Their expenditure is at the modest retirement, and their superannuation money is going to return 4.7% return. So this is along the lines of a balanced portfolio, like ethical balanced option within Christian Super, for example. And we're saying that Joe has 120 in super and Mary has 50. So total assets of $170,000. Now this is modelling their situation. So they start with $170,000 of money, which is the purpley blue line at the back. Their income requirement is $34,000. This red line here that's their expenditure. And then what they've actually achieved is the green bars. So they're actually generating more money than they need to live on, and so they're saving that money, and their assets go up over time. So their assets increase from $170,000 up to, when they're nearly 100 years of age, their assets are going to be worth $600,000. So they're actually spending less than their earnings, so their assets go up. And that's living on a modest retirement, because the age pension is actually more than what we've assumed here. So the age pension is like $800 more than what they're living on. So they're just living on the age pension and they're saving all their earnings on their super money. Now what happens, just to give you an indication of the sources of income, so you can see here that the age pension is this aqua colour, and the superannuation earnings are the purple, and so they're basically just saving their earnings from their superannuation pension money. Because they can't get the money back into super because they're retired, they have to start to put that into other investments, and then this other investment money is this orange bit at the bottom here. So it's just showing the sources of income to provide for that $34,000 indexed up with inflation over time. So that's Mary and Joe living on the modest retirement. Now, it's a very similar story for, we've got Mary here, who is a single person, owns her own home with no mortgage. Again, the modest retirement of $24,000. She's got $120,000 in super. And in this scenario, again, her assets continue to grow over time. They don't grow as much because there's not quite as much. I think as a single person, there's probably more expenditure to run the home, etc. And so we don't get to quite to the $600,000 level, and it sort of tapers off in Mary's 90s. But a similar sort of outcome for a single person with $120,000 in their super, living on $24,000, or that modest retirement that we talked about earlier. Susan asks, do they take debts on property into consideration when working out assets? Susan, I assume you're talking about the Centrelink assessment of assets. They take into account debt on investment assets, but they don't take into account debt on your family home because it's an asset that is not tested for Centrelink purposes. So the debt on it doesn't really help you in that instance. But if you've got an investment property that's worth $400,000 and you've got $200,000 debt, then the asset that will be tested from Centrelink's perspective would be $200,000. Simon asks, did you say that super is counted as an asset? Super is counted as an asset unless you are under age pension age. It's not counted as an asset for Centrelink purposes. John says, there's black on the screen. Is that my internet connection? I think it must be, because I've got two screens going. I don't think I can see black on my other screen that I've got going to try and make sure that you're seeing the right thing. Fiona says, so are you saying that Mary spent all her assets by the 90s? Is she living on her pension only by then? No, so Mary is still got, if you look at the chart here on the left hand side, we've got Mary starting with $120,000 worth of assets. By the time she is nearly 100, she's still got $250,000 of assets there available to her. So she's still mainly living off the age pension. Later on, she might be eating to her assets a little bit, but she's still got $250,000 of assets when she's 100 years of age. So there's a couple of scenarios on living on owning your own home and living on a modest retirement. But what if you want to live on what we ASFA have deemed a comfortable retirement? So in this scenario, we've said $59,000 per annum, and you've still got $170,000 in super. Now this changes things significantly. So the assets of $170,000, because the age pension is only going to generate $35,000, you're going to need to draw down on your $170,000 to the tune of about $25,000. So you're going to eat into your assets very quickly, to the point that between 65 and 73, you'll utilised all your superannuation assets, and you're then reliant on the full age pension, which means that you're not going to meet your income requirements over. So there's this big gap here, reflecting that you're going to be living on your age pension from 70, or Joe and Mary are going to be living on the age pension from 74 years of age. So that gives you an indication of how the your expenditure and the age pension sort of interact. Now, to do the same scenario for Mary, so a single person this time living on a comfortable retirement of $43,000, and it's a similar sort of scenario, except I think she runs out a couple of years earlier than a couple would do in that situation. So $120,000 of assets would run out at 72 years of age, and Mary in this scenario would be fully reliant on the age pension, so that $25,000 per annum. So just trying to give you an indication of the interaction between the age pension and your assets and how much you spend. So the biggest indication of whether you're going to meet your retirement needs is how much you need to live on. And you can see the big difference between the modest and the comfortable retirement. So if we just pulled back the expenditure by $5,000, for example, so 43 down to 38, that would extend the asset, the life of your Mary's assets out significantly. But let's say Mary and Joe, in this instance, want to maintain their $59,000 per annum. How much in assets would they need to have to maintain that long term? So we've said that, well, they, in addition to their home, they've got $600,000 in super, $450,000 for Joe and $150,000 for Mary in this scenario. What happens is they're meeting their income requirement, so they're meeting their $59,000 per annum up until they're 91 years of age, and at that point in time, then they're reliant on the full age pension. But they're basically able to provide for their needs up until their 90s. And we might find that into the 80s, their income requirement might drop back from $59,000 to say $54,000, $55,000 if ASFA's research is correct. And often people actually communicating that they're spending less into the early 80s as well. So their lifestyle is maintained into their 90s. We've got the similar scenario with Mary. If she's got $450,000 living on a comfortable retirement of $43,000, then her assets also last out until 93 years of age in that scenario as well. So a little bit more asset means that you're able to provide for that comfortable retirement longer term. But it's amazing how, as I mentioned earlier, how much difference $5,000 of expenditure less means that your resources will last a lot longer. So you, if you're not able to, if you don't have, for example, you're a single person, own your own home, and don't have $450,000 but would like to live on a comfortable retirement, then a comfortable retirement for you might be actually more like $38,000, and you might actually be able to do that on $300,000 and achieve it long term. So it's hard to run every single scenario, but it gives you a good indication of the sorts of figures you're looking at to try and achieve those, achieve your goals. Now, another thing you could potentially do is that Joe and Mary could take a little bit more risk. Rather than being in a more conservative option, they could take more risk in their investments. So they might be investing in the growth option rather than the balance option, and they might be able to assume a higher level of return of 6.1% return. The drawback here is that it doesn't always, over the short term, achieve higher levels of return, particularly if you were impacted by things like the global financial crisis. But if there was a higher level of return, then Mary's resources end up being about $200,000 at age 100, so they last a lot longer. They're lasting, 10 years more. She doesn't actually run out of resources just by assuming a higher level of return. But we like to assume under 5% for most projections, because that's generally a balanced fund in this low inflation environment. It's done. Most funds have done better than that, and Christian Super has done a lot better than that in the last year. But over the long term, we try to be conservative in those growth assumptions. Now we've got a few questions coming through. Gavin, what inflation rate is built into these figures? Good question. I haven't checked it recently, but it is between 2 and 2.5%, I'm pretty sure. I'll have to come back to you with that. I can't quite remember, Grant, so sorry that I don't have that. But yeah, I understand that's the CPI. I can go back and check those figures for you later on if you're keen to know. But it's basically a reset as per the longer term expectations of CPI between that 2 and 3% mark. We've got Fiona saying, thank you for your patience. Your explanations have made the dealing with the superannuation makes more. Pleasure, Fiona. No worries. But couldn't they be left with nothing? I was in a super fund that sent me a zero balance 1 year because they had used the lot. Yeah, that's exactly right. If you've got a low balance and you've got insurances or insurance premiums coming out, your superannuation can go down in value. But that's where it's really important to pay attention to your super fund. Look at what fees are going out. Look at what returns you've got coming through. It's really important to understand your super money. Generally, if you've got larger balances, the fees aren't going to eat into those larger balances because the return should really cover those. If super is not deemed as an asset prior to retirement age, and if super is not deemed as asset prior to retirement age, and you can't get the pension, yeah, Peter, I'm talking about the strategy I was talking about earlier. If one spouse is of pension age, so can get the pension, and the other spouse is under pension age, and their super isn't tested, then it's a good strategy. Once you turn pension age, superannuation money is a tested asset. So that's what I was referring to there. You have to live on your own money. Yeah, you can do lump sum drawdowns on the superannuation in the younger spouse's superannuation if they've got access to it. So yeah, it's we'll talk more about that strategy in Centrelink webinars in the coming months. So come back to those webinars if you're interested in that. Thanks for those questions. And we've got so another question that I sometimes get asked is, well, what if I want to retire prior to pension age? Then you just need more assets, basically, because you're fully reliant on your own resources. So in this scenario with Joe and Mary, if they want to live on $59,000, then they generally would need another $300,000 to pay for, assuming that they're going to retire at 56, I think it is. Retire at 56, which is their preservation age, age at which they can access their superannuation money. They're going to eat into those resources a little bit more quickly. So that $300,000 will provide for that that income up until they turn pension age, and then because they get a part pension at that point in time, they don't eat into their assets as quickly after that. So it might be another $250,000 to $300,000 that would be required to meet your retirement needs if you're a couple wanting to retire at 56, 10 years before your pension age. So how to prepare for retirement? There's a few key things that you can do. The first thing that I mentioned earlier at the start of the session was make sure you, and this particularly applies to men who have been working full-time for a long time, work out what you're going to do with your time because there's poor health, longevity outcomes for particularly blokes who don't have plans for their engagement in retirement. Next steps in the process are to pay off consumer debts, save an emergency fund, 3 to 12 months of living expenditure in that emergency fund, save for major purchases, car, business, home, and education are generally the 4 major expenditures. Buy your home and pay off any mortgage, build your retirement savings, and take advantage of tax savings and asset building strategies. Now, some of those tax savings and asset building strategies are to purchase a home or investment property, the government co-contribution, eligible spouse contribution, salary sacrifice, transition to retirement, deductible contributions to offset capital gains tax, cash out recontribution strategies, and small business CGT concessions. Now, we've hit the hour mark at the moment, and we haven't got time to run run through those, but we will run through those in the coming webinars. So the next webinar is how to transition to retirement, where we'll focus in on salary sacrifice and transition to retirement. The benefits of those strategies have reduced, but they're still well worthwhile considering and well worthwhile pursuing. So register for the next webinar. You'll be sent an email to register for that one. If you need further information, then we'll be emailing the webinar recording to you. The next webinar is the How to Transition to Retirement webinar. You can seek personal financial advice through us if you like, either on our website or by calling our 1300 number. And Christian Super Health Desk is a great resource as well. So 1300 360 907 or the website christiansuper.com.au. So I've got through the content in an hour. I was hoping actually to get it through it a little bit more quickly. But now the plan is to answer your questions. So I'll give priority to your questions live, and then I'll run through. There's about 60 questions here that you've lodged on registration for the webinar that I'll try and quickly walk through so that everybody who comes back to the recording can come back to their question that they asked at that on registration for the webinar. So feel free to ask your questions now using the chat section. I'll run through those questions as best I can, and then I'll go back to the questions that you asked on registration of the webinar. If you do have to go, I will be including these questions in the recording that you can look at later, and you can fast forward through to your question in that as well. So if you do need to go, given it's pretty late now, you'll get a recording. So Barbara says, how do I go about retiring before pension age? Well, you can retire at any point in time at all. The key thing is making sure that you've got sufficient resources to provide for your income needs. Like we talked about with that last scenario, it was that if you were retired 10 years earlier than your pension age, then a couple might need an extra $250,000 to $300,000 to provide for those 10 years because they're not going to get government support during that time. So there's no requirement to, you can retire at any point in age you like, you're just going to need to be able to provide for your income needs. Susan asks, can you confirm salary sacrifice limits for the 2017-18 financial year? The concessional contribution limits are, I might just see if I can jump out of the webinar. So the presentation, I'll just go through that if I can. I can't see the. I was just trying to pull up the slides so I could give you a visual. But it's the concessional contribution limit is. Actually, I might be able to find it on here. If I go back to here, contribution limits. Here we go. Then on concessional, and then I'll go to. Sorry for the delay here. Concessional contribution limits. Here we go. So for the for this financial year, the 2017-18 financial year, the concessional contribution limit is at $25,000 per annum. This is not the figure that you can salary sacrifice. It is because this figure includes your superannuation guarantee. So if your employer is putting in $5,000 for you. Into your super fund, then you could salary sacrifice $20,000. So that limit, this annual limit of $25,000 for this financial year, is includes your superannuation guarantee, the 9.5% your employer puts in. So it was either $30,000 or $35,000 last year, but it's now reduced to $25,000. One thing that has changed is that you don't have to actually salary sacrifice that money this financial year. They've actually freed up the rules so that you can actually take money that's in your bank account, put it into your super fund and claim a deduction on it. It has the same outcome as salary sacrificing, but it just provides a little bit more flexibility. If you've not salary sacrificed all throughout the year, you get to June, you have the potential to salary sacrifice 20 grand, but you've only got 2 grand of income coming through because it's close to the end of the financial year. You can now, in this new in the 2017-18 financial year, put money that you've got in your bank account into super and claim a deduction on it using an intent to claim a deduction form, and you can achieve a similar outcome. So good question. We'll talk through that in the next webinar in a bit more detail. Thanks, Susan. What is the date of the next webinar? The next webinar is the 14th of August. I'll send out a registration link to you in the email that we send out for giving you the recording. Peter said, thanks, great info and presentation. Pleasure, Peter. You're very welcome. Peter's saying, different Peter, saying thanks, a pleasure, Peter K. I keep losing the sound, Barbara. I'm not sure why you keep losing the sound. I think others have been okay with sound, but I'll send through the recording. So if you want to go through and look at the recording, Barbara, then you'll hopefully be able to catch up on the bits that you've missed. Richard said, thanks, a pleasure. Julie Ann says, can my husband close off his superannuation account in accumulation phase, $100,000, into my Christian super account in accumulation phase? Yeah, so the mechanism for doing that is that you don't just transfer or roll over from one spouse's account to the next spouse's account, but you've got to withdraw it. Or you can do it. Let me keep it simple. You can withdraw $100,000 from your spouse's account to put it into his bank account or a joint bank account, and then you can take that money if you are eligible, you're under 65, and you haven't exceeded your non-concessional contribution cap. You could put that $100,000 into your account then. So it's cashing it out of one spouse's account and then contributing it into another spouse's account. That's how you could go about that. There also is another way to get money over into your spouse's account, which is what we call a contribution split. You can split 85% of the concessional contributions, these types of contributions, each year to your spouse's account. So that's another way of doing that, Julianne. John W. says, thanks, bye now, a pleasure, John. Good to have you with us again. Susan says, thanks, no problem. Lyndon says, thanks, bad connection, bad internet connection. Yeah, sorry, Barbara, check out the recording when you can. Lindy says, thanks very much. I like the graphics, which makes the content easy to understand. Pleasure, Lindy. Some people hate all the graphs, so glad that you like it. And then, thanks, Simon, for letting us know that your sound has been okay. Good to be reassured that it's not our end. It might be just that Barbara's internet connection. Appreciate that. Keep your questions coming through on the chat section. Otherwise, I'm going to plough through these 60-odd questions. I totally understand if you need to go. It can be a little bit tedious, but what I'm trying to do here is answer everybody's questions that they asked on registration for the webinar. But obviously, I'll give priority. If anyone wants to ask a verbal question, just put your hand up and I can open your line if you've got a microphone to do that. We can do a chat that way. So what we've got here is a few questions. So we'll start with Sylvia saying, how can I quickly grow my super and how much money do I need for retirement? We've largely covered off that in the webinar, but to quickly grow your super, it's about getting as much money into your super and tax effectively as possible. So salary sacrifice, government co-contribution, spouse contribution if it applies, and then other contributions over and above that as well. So, and then also factoring in what investment option you're in. So holding it in cash is going to get you 2 or 2.5% return. Holding it in the high growth option is going to have a lot more risk, but ideally over the longer term would get you a lot higher level of return as well. We've got Richard who says, phases of retirement, what I have access to when and tax concerns. So you get access, so that's a good question a number of people asked, is when can you access your superannuation money? And I'll just quickly when can I access my superannuation? There's two criteria. One is that you need to reach a preservation age, and that's based on your date of birth. So people turning 56 now need to you need to be turning 56 to have reached your preservation age at the moment. Once you've reached your preservation age, you can access your superannuation money in some format. And it depends on whether you've satisfied a condition of release. If you've satisfied a condition of release, which is one of these criteria, then you can access all of the money. If you have not satisfied a condition of release, then you can move the money to pension phase and access up to 10% of it. There are some tax implications when you're under 60. Drawings from super when you're over 60 are tax-free. So that's when you can access your superannuation money. How you can access it is if you've satisfied a condition of release, you can take a lump sum. If not, then you can take it in the form of a pension, and there are minimum amounts there. We'll go into that in a bit more detail in subsequent webinars. Just got a question coming through. Thank you. You have to leave now. Pleasure, Jenny. Thanks for joining us. Thanks for the comments. So going back to how much do I need for retirement? Actually, I might just need to go back to that question. So going back to Richard's questions, Alan says, how to manage finances best towards retirement? That goes back to having your home paid for, having a cash reserve, and the rest of your money being in the pension phase of superannuation. Sherilyn says, ensuring that I have enough money to retire on, and what age is achievable to retire at. We've largely covered that off in the webinar, but the next best way to do that is through an initial consultation that I talked about earlier. Elisma says, I do not own my home yet, still $230 to pay. My super has just reached 100,000. How will I be able to cope? Well, you can continue to pay down your home as quickly as possible. I would generally try to continue to work and pay down your home. And you didn't say how long you have got until you want to retire. And don't get pushed into or think that you need to retire at your pension age. If you're healthy, it actually has great outcomes all round if you continue to work beyond your pension age. So it's hard to know without more details, but continue to plough into the mortgage, salary sacrifice if you can, build up the superannuation money, and then when you factor in an age pension, you might be able to live comfortably throughout your retirement. It's the best advice I can provide there. Leanne asks, I will be resigning my part-time position at my school and won't be receiving regular super. Is there anything I need to do? It depends on what your age is. Maybe if you are over your preservation age, so you're over 56 years of age, one thing that is beneficial if you're not, if you have satisfied a condition of release, which would be saying that you're retiring and you don't intend to return to the workforce, or if you're over 60, you've retired, and you don't need to say that you don't intend to return to the workforce. You could actually move your superannuation money to pension phase and get earnings on your super tax-free. So that's a good thing to do. Look at the next webinar if you want to learn more about that on the 14th of August. Spencer says info on the senior tax offset. The Senior Australian and Pensioners Tax Offset is an additional $1,600 of rebate that you can get if you are of pension age and you're under a certain income threshold, which basically means that you can earn up to $29,000 without paying any tax. That's the tax-free threshold for somebody who is of pension age. Let me know if you need to know more about that, Spencer. Barbara says, rules keep changing, confused. At what age am I now allowed to retire and claim my super funds without tax penalties? Well, as soon as you turn 60 years of age, you can access your superannuation money tax-free. You might not be able to access all of it depending on whether you've satisfied a condition of release there, Barbara. But you're allowed to retire whenever you like. It's just whether you have funded your retirement or whether you're going to eat into your resources too much if you retire too early prior to reaching your pension age. And Noel says, if I can't get a pension, I won't have enough to live on when I retire. Well, if you can't get a pension, an age pension, then you'd have to have assets over $820. If you're a couple, $827,000, or if a single, I think it's $550,000. So if you can't get a pension because of your assets, then you've got your assets to live on. If you haven't got enough, if you've got assets under the thresholds and income under the thresholds, then you get a part pension. So I'm not really sure what your concerns are there, Noel. Jeff says, what are my options for a retirement plan? I'm not sure whether you're asking how do we help you with a retirement plan. If it is, then we can either help you with initial consultation, we can help you with specific recommendations, and we can help you with implementing and ongoing advice as well to get you through to retirement and beyond. Now I've got some questions coming through, so I'll just flick back to those. Must go now, Stephen. Thanks, Stephen. Appreciate you being on board. So I'll just keep ploughing through these, mainly for the recording, but if for those of you that are still online and interested, then that's great as well. Mark asks, strategies for topping up super between 60 to 67 years of age, replacing the old transition to retirement option. So we'll delve into this into the next webinar, so join that one and I'll go into that in a bit more detail. But effectively, you can continue the transition to retirement strategy. You might not be able to get as much into super because of the concessional contribution limit being reduced, but you could actually put more money in post-tax money. Craig asks, accessing funds after retirement. Yeah, so you can access money from your superannuation once you've reached your preservation age, and but also once you've turned 60, you're able to access that money tax-free. So you can access your money at retirement. Michael says, you want to learn about TTR? Check it out the next webinar. Donna asks, can I add extra to my super but draw on if I need if I'm over 55 years of age? Yeah, that's the transition to retirement strategy. The next webinar will cover off that in a lot of detail. But you can access money if you are over, depends on when you turned 55, but the new preservation age is 56 years of age for those people turning 56 this year, I think. But certainly you can put extra money into super fund and you can draw money from your superannuation. There is there is a greater benefit when you turn 60 because what you're drawing from it is fully tax-free. So yeah, there is less benefit under 60 years of age, but it's still possible. Grant asks, when I should start making adjustments to super and other similar things? Well, as soon as possible, Grant, would be good. It's good to review it as early as possible and understand it as early as possible. Christopher asks, how does a super pension affect my government age pension, and what is the best way to set it up? I have 266 in super. Yeah, there used to be a few different ways to structure your superannuation. There was a benefit of being in pension phase rather than the accumulation phase because it wasn't a deemed asset. But now there's very little difference between having money in superannuation or the pension phase or in your bank account. So there's not a lot you can do, but from an age pension perspective, but from a tax perspective, it is good to have your superannuation money in the pension phase because it pays no tax. The drawings are tax-free as well. Marianne says, asks, how much may we take out of super in a lump sum? Well, you can take as much as you like as long as you have satisfied a condition of release. So you've reached your preservation age and you have satisfied a condition of release. You can do it tax-free if you are over age 60, or you can do it up to, I think, $200,000 tax-free in a lump sum if you're under 60 years of age. Graham asks, When do I know I have enough to retire? That is, can I retire early and still have enough in super to last? That depends on what your income requirement is and how much you have. So we did a few projections there. We can project your particular situation in an initial consultation if that's what you're seeking. James asked, what taxes can consume away at my retirement funds after retirement? Generally, when you're in retirement, we're able to structure it so that you don't pay any tax at all. So your retirement earnings are tax-free, all your income is tax-free. So generally in retirement, if you've got assets under the certain thresholds, you're able to generate tax-free income in retirement. How to best fund retirement from super? The best way to do that is to move your super to pension phase and start drawing funds from it. We've got Robin who says, how to plan for my retirement future as a single woman with a small super account. The key thing is to continue to build up the super as much as possible. Ideally, pay off your own home. If that's not the case, then continue to build up the super, and you will be able to factor in with your Centrelink projections some rental assistance in there. Susan says, having sufficient money for retirement, widowed unexpectedly 59, 3+ years ago, so working casual hours and cutting some debt. That's great. So paying off the debt is awesome. Once you've paid down the debt, or potentially slightly before because of your age, you could start to plough money into superannuation tax effectively. Check out the next webinar for more info. David asks, I am 57 years old and I've recently paid off my mortgage with 10 years of working life. How can I best prepare for retirement? The key one there is to maximise your concessional contributions to superannuation to save tax and build your super. By the time you're in the year that you turn, financial year that you turn, we used to advocate moving your money to pension phase, but because you have to satisfy a condition of release, there's not that benefit to be obtained by moving to pension phase at the moment. So the key one would be boosting your super by salary sacrificing. Sue says, will I have enough money to retire on? I'm not sure. It depends on what resources you have and what income you need to live on. Anne says, how long can I survive on my superannuation when I've only worked for 13 years? Depends on what you need to live on. If you can largely live on a modest retirement, which is mainly the age pension, and you get the full age pension, then you can survive a long time. Diane says, when can I retire? I'm not sure. Peter asks, what is the amount I can receive from the government still work without losing money when I'm retired? You're talking about the work bonus here, which is a good question. The work bonus, you can earn up to $6,500 from employment, and it won't affect your age pension. So that's each. If you're a couple, you could both work and earn $6,500 and it wouldn't impact your pension. It needs to be employment income, business income or self-employed income. Doesn't fall under that category. Kevin asks, I am to retire in October, November, but didn't provide more info. Colin says, I'm 55, I don't own my own house, and I'm wondering what avenues I should use to build up my financial base for retirement. The key would be to, build up your cash reserves, build up your super, tax effectively. Just continue to save as much as you possibly can. You might find that you might be able to buy a reasonably priced home at some point. If not, then you can, plan around some rental assistance assisting you on a longer term basis from the government. The key thing is to continue to build up your assets. Richard said, changes in asset and income in order to qualify for the pension. Changes to asset and income in order to qualify for the age pension. I'm not sure what that question is, Richard. Ken asks, at age 61, should I buy a city house now or invest funds from the sale of a no capital growth house in the country, invest or in super? I'd get back to the ideal that it's good to own your own home, have a cash reserve of 6 to 12 months living expenses, and then the rest of the money in the pension phase of superannuation. It's a really good, well-structured, simple approach to retirement. Gary asks, financial strategies in retirement, making best use of superannuation. Yeah, we'll talk about that in future webinars. Jeff, not having enough in super. Diane, we don't have much super but are planning to sell our property to help fund our retirement. What is the best way to invest? Yeah, often it is, depending on what your age, to have the funds in the pension phase of superannuation, particularly if you've satisfied a condition of release, because it can be tax-free earnings, and it's a great way to structure things. David asks, can I still minimise my tax obligations when over 60 by salary sacrificing super, only to withdraw the same amount each year? Yeah, you're talking about the transition to retirement strategy. We'll go into that in the next webinar in a bit of detail. Madeline says, with what I've accumulated in super, what is the smartest way to use it optimally? That is, stretch it as best as possible. Yeah, the best thing is to draw the minimum amount, save as much as you can, put any surplus back into superannuation, have it in pension phase, tax-free pension phase as soon as you're eligible to it, to do that. Stephen says, is paying into a health fund really necessary if the public system looks after you as professionally? You're talking about private health insurance. Is it really needed? There are two reasons we generally have private health insurance. One is to avoid the surcharge if your family or individual income is over the thresholds, and you end up paying a surcharge. And if you're paying the surcharge, often you might as well have the cover in place instead. If you're under the thresholds of needing to pay the Medicare surcharge levy, then you don't need the cover. The only reason you might take out the cover is because you want to have a particular operation and that will reduce your waiting lists, or you could choose your own doctor, or you could get better services through the private system. But if you're comfortable with the public system, then that's great. Marilyn asks, how to set up my super fund when I retire? How will that work? How long before I retire do I need to get that set up? Well, you can start to move to pension phase when you reach your preservation age. Turning 60 years of age is the key date, because then what you draw from your super is tax-free. So you could start as early as 60, but once you've turned 65, that's a key date, even if you're going to work longer than that. The reason 65 is a great date to move to pension phase is that it becomes an account-based pension, which means that all the earnings are tax-free rather than being taxed at 15% like an accumulation account. Rosalind asks, how to save, invest for retirement. We'll talk about that in future webinars. Pedro asks, I'm 66-year-old and intend to continue to work for another 4 years. How will I fund my retirement? If I retire at 70, what will it got cut off? So sorry, Pedro, didn't get the rest of the question. Peter asks, how much can I earn from all sources, including a defence service pension, and still access a government old age pension? Well, I'm pretty sure the defence service pension will be your pension, which is the equivalent of a DVA, Department of Veteran Affairs pension, but I'd have to look at your particular circumstances to be able to answer that question well. Tessa asks, how to save for retirement now the salary sacrifice amount has been capped. Well, if you've got surplus funds over and above the salary sacrifice thresholds, then a great way to save is to make non-concessional contributions over and above that, or you could go out and invest in investment properties or shares outside of superannuation as well. Jeff says, I am about to retire. What should I be doing in preparation? Looking at what your retirement income needs to be, and therefore setting a goal about what assets you need or what capital you need is the best way to start, and then work towards building that asset up. Ideally, with assets in the pension phase of superannuation. Jill says, we will only have 25,000 in super when we retire. Should we leave it in super, or are there alternatives? With balances, I think you might need to have $20,000 or $25,000 minimum to move to pension phase in superannuation. So I would tend to think with that sort of balance, if you've retired and that's your only asset, I'd almost be tempted to pull it out of superannuation and hold it in a a bank account. But if you are wanting to invest the assets and you can add a little bit to it, another way to do it would be just to move it to the pension phase of super. You'd need to draw a little bit amount from it each month or annually at least. But that would be a simple way to invest it if you didn't want to have it all sitting in a term deposit. Simon asks, what can I do to prepare for retirement in the next 9 years when I reach retirement age? Yeah, we ran through that slide, and the next webinars will go into a bit more detail. Lynn asks, my husband and I are selling our home. How much can we each invest into our super from the sale? Depends on what you've contributed previously and what your age is. If you're under 65 years of age, you can put up to $300,000 each into superannuation. That is $100,000 annual limit, and you can bring forward 2 years. If you're over 65 and you're not working, you can't put any superannuation, any money into superannuation without satisfying the work test. So if that's your case, you're both not working, you're over 65 years of age, and you're looking at selling your home and wanting to put some surplus funds from the sale into superannuation, I would consider selling, and you've owned your home for 10 years, I would consider selling after the 1st of July 2018, because there's a rule that's before Parliament, or going to be before Parliament, to allow you to put $300,000 each into your superannuation accounts. Christine asks, 60 years old now, what is the best way to transition to retirement? Is it worth drawing down each year a small amount? Yeah, well, it's only valuable to draw down a small amount if there's use with that money. Or you've satisfied a condition of release and you can start an account-based pension, which means that you can earn tax-free money. Chris, I got a question. Got a live question. That's a bit more exciting for me. Thanks for chipping in. My wife and I are about to receive a large inheritance. I, 57 years of age, have little in superannuation, and my wife has no superannuation. What advice would you give re what to do with this inheritance? Yeah, it's a good question. I guess the first thing is to make sure that you've paid off debt on your home. You've retained a cash reserve for your needs, and so that's the 3 to 12 months expenditure. Retain that sort of funds in an at-call account in the lower income earner's name, so that you minimise tax. And then the next question is, well, what do you do with the surplus? Now, there's a range of options. So you could, potentially go and invest in a property in your own name. You could invest in shares in your own name, or you could invest through other structures like trusts, company, or super. Depending on whether you're likely to you or your wife is likely to satisfy a condition of release. One serious option or good option would be to consider superannuation. So putting it into super, you get your earnings would then be taxed at 15% if it was in the accumulation phase. But if one of you could satisfy a condition of release, then you would be able to roll that money to pension phase and pay no tax on the money, so you're able to sort of boost it. If you are considering doing that or taking that sort of approach, and you've got some superannuation money already, what we often recommend is doing it into a different account so that you keep the tax component separate, because these monies would be put in what we call non-concessional contributions, which would within the fund be called tax-free components. Money that's tax-free can pass to the next generation tax-free. Other monies that you've salary sacrificed or your employer has put into your super fund is not tax-free components, and if that passes to your beneficiaries, not to each other, husband and wife, if it passed to non-dependents, like your adult children, for example, then it's taxed at 17%. So to keep it's separate. If you were putting surplus funds into super, we often put into a separate superannuation account. I hope that helps, Chris. Just feel free to email some follow-up questions if you have a few. Certainly happy to help there. Can't remember who I got up to here. I think it was Andrea. What happens if you haven't got much in super? How can you make the best of it? Well, just continue to build it up as much as you possibly can. Linton, what are the phases of retirement that I should be aware of? We talked about those earlier. Fred says, what do I need to prepare for retirement in 5 years? Pay off your mortgage, have a cash reserve, and build up your super as much as possible so that you can provide for your retirement. There we go. Oh, there's not a lot. Graham wants to know about capital gains tax. The next webinar is Transition to Retirement. One after that, we address capital gains tax and how to deal with it. Peter says, where can I obtain the greatest profit? Well, in the higher growth options is generally where you get the highest level of return, but you do also have the highest level of risk. So short term, you might not get the highest level of return. Keith asks, how to set up the most tax-efficient retirement portfolio? Most tax-efficient retirement portfolio is what I mentioned earlier. Own your own home, have a cash reserve, and then the rest of your funds in the pension phase of superannuation in what we call tax-free money. So not tax-free, tax-free components. Then it's not only tax-free earnings, it's tax-free drawings, and it can be tax-free money to your beneficiaries as well. Graham asks, is my superannuation actually safe, for example, from a financial crisis? It's not safe from a crisis. So if we went through a global financial crisis again, depending on what investment option it's invested in, it could be negatively impacted by a global financial crisis type scenario. One way to manage that is to hold some of your superannuation in cash or the ethical cash option. That means that if the global financial crisis kicks in and equity values and property values go down, you'll at least retain the value of that cash option, and ideally let the other ride the wave of the other investments. So if they've gone down, hold out and let them go up again. So you're not safe from the financial crisis, but you can put things in place to make sure that you're buffered sufficiently for your particular circumstances. There's a video that I've created called that you can access at cornerstonewealth.com.au/buffer, which is all about how to buffer yourself from a global financial crisis in the future. Paul asks how to invest in retirement. We will talk a little bit about that tonight. We'll talk more about it in the subsequent webinars. Lindy says, what is the best place to put my super when I retire? And what are the options to draw down a pension from? Again, often the pension phase of super is works well. I'm just making that really simplistic, but for 90% of people, that is a great way to go. Simon asks, after paying off the mortgage, which comes next, building the cash reserve or putting into super? Good question. I would say, whilst maximising your tax efficiency, I would be focusing on the super, but you do need to make sure you got sufficient cash reserve. So if it's beneficial for you to salary sacrifice up to the $25,000 threshold, I would do that, and then over and above that, save towards your cash reserve. And then once you've got to your cash reserve, that might be between 3 to 12 months living expenditure. Then you can start to focus on putting into superannuation, even if it's non-concessional contributions. Hope that answers your question there, Simon. I'll keep ploughing through these other ones. What have we got? Graham, Lindy, Maxine. How do I calculate how much I need to live comfortably in retirement? We talked about that earlier. Julianne says, can I transfer my super from this? Yeah, you can't transfer it. Oh, you can cash it out and recontribute it. I think I answered Julianne's question earlier. Alan asks, what amount should I be aiming for in my super fund in the next 2 to 3 years? Depends on how much you need to live on. As we've talked about earlier. Katharina, how much can I earn as a relief teacher before it impacts on the pension? You can earn, it's actually $250. The work bonus is $250 per fortnight. So if you're earning less than $250 per fortnight, then it won't impact your age pension. Whoa, got another page. Oh, this is the last page, I think. So we've got light at the end of the tunnel. Thankfully, because it's 10 past 10 here. Petrus, how to survive on a pension with only 20 years contributions, at least the house will be paid in full. Yeah, that's great. It's great that you're paid in full. Build up the superannuation, have your cash reserve, and then look at how much you might need to live on in retirement. You might find that you're actually provided for well. Leanne asks, how do I work out how much to draw down each year from super once I retire and how long it will last? Well, there's a minimum amount that you need to draw down depending on your age. Between 55 and 65, you need to draw down 4% of the balance. Between 65 and 75, you've got to draw 5% of the balance, and then it increases from there. So you start with a minimum. If you don't use that, then I would save it. If you can get it back into super, then because you're eligible to, then well and good. Otherwise, you save the funds in outside of superannuation. Narrowly, when is the right time to retire with adequate funds to live on? Well, as soon as you have adequate funds, even if you have adequate funds, often people continue to work because they choose to work. They enjoy it. They feel fulfilled. But if you want to retire and you have adequate funds, then go ahead and retire. Jenny, I will not have enough to retire on. Will not have enough money to live on. Can I also claim part pension? Depends on what your income and assets are. If you're under the income and assets thresholds and you're of age pension age, then you'll be able to get a part pension or potentially a full pension depending on what your level of assets and income you have. Narelle asks, I want to plan for retirement in the next 5 to 10 years. What do I need to do now to accomplish that? Pay off your mortgage, save retirement, save an emergency fund, and then boost your super. Philip, what practical things do I need to do when retiring to access my super? Check out the next couple of webinars, but the key thing is either moving to pension phase. Sometimes we also include a cash out recontribution strategy in there as well to clear some of the tax components, which helps your beneficiaries, not necessarily you or a spouse, but it can help longer term. Petrus asks how to survive on a pension with only 20 years contributions, at least the house we paid for in full. How to survive on a pension for only 20 years. Oh, okay, I think I've already covered that one. Yeah, it's up further. And Rose, whoops, nearly missed Rose's question, which was Centrelink assets calculation for pension. One partner older than the other. I know that super should be transferred to the younger spouse. As a spouse super is not counted in assets. What about vehicles, caravan, etc.? Can just in younger spouse's name, are they still counted as assets for older spouse's pension? Yes, all assets, vehicles, caravans, bank accounts, all those other assets, except for superannuation in the accumulation phase of the spouse who was not yet of age pension age. That's the only assets that is not tested for Centrelink purposes, apart from the home. There are some exempt assets, but they're the two main ones. Your home is exempt, and the superannuation in the accumulation phase of a person who is not of age pension age are not tested assets from a Centrelink perspective. Kevin asks, I'm thinking of retiring in September. How much would my current super provide each week? If I were to add another $100,000 to it, what would that provide each week? What taxes does my super earnings attract? When you're in the accumulation phase of superannuation, your earnings are taxed at 15%. When you're in the pension phase, it depends on whether you've satisfied a condition of release or not. If you're over 65, that's an automatic catch-all of satisfying a condition of release. and you can move to pension phase, and there's no tax on the earnings, no tax on the drawings either, because you're over 60 years of age. You've got a minimum amount that you need to draw from your super, 4 or 5% if you're under 75. So if you had an extra $100,000, you'd be drawing an extra $5,000 minimum a year if you're between 65 and 75 years of age. I hope that helps, Kevin. And I think I've reached the end of the session, and someone's got a question. Barbara, if I do not need as much as 4% minimum drawdown, how do I put it back into super? Depends on, if you're under 65, there's a couple of ways of doing it. It depends on whether you're earning funds, and it's worthwhile putting it in as what we call a concessional contribution. So that means that you pay 15% tax on the way in, but that might be less than what your marginal tax rate is. If you're not paying tax in your marginal, if you're not paying tax in income tax, then the way that you would put it in is as what we call a non-concessional contribution. You just transfer it in. There's no tax payable on the way in, and it can go in like that. The threshold for those types of contributions is currently $100,000 per year. If you're under 65, you can bring forward 2 years to contribute $300,000 in any 1 year. You just need to make sure that you haven't breached those limits in previous years, though. Simon says, thank you, very helpful. I look forward to the next webinar. Yeah, pleasure, Simon. We go into a whole series. I think the next 4 are really detailed. The next 2 are really about retirement planning, transition to retirement, and then some of the more complex strategies. And then we go on to Centrelink, a couple of Centrelink webinars that go into a fair bit of detail with Centrelink and some of the strategies that we apply there. So, it'd be great if you can join us. And Kevin, thanks, very helpful. Pleasure, Kevin. Thanks for joining us and for the interaction. I don't know whether I answered your question particularly well there, so feel free to follow up with questions online now, Kevin, if I haven't really covered off that sufficiently. So thank you all for being online, particularly those of you that have stuck it out to the end. You've done very well to listen to my monotone voice for that period of time. Look forward to interactions if you're going to join us in the next webinars. Thanks again for being online, and good night.